Welcome to This Explainer. I am so pumped to dive into today's source material because it literally flips everything we think we know about money totally upside down. I mean, just imagine for a second that you walk into your local bank and the manager cheerfully tells you that their main goal for the next 10 years is to make sure your hard-earned savings lose exactly 1/5 of their value. You'd probably turn right around, call the cops, and demand they arrest the guy for blatant theft, right? Well, actually, according to our sources, this isn't some crazy hypothetical scenario. This is the official, publicly stated policy of the most powerful financial institution on Earth. Today, we're going to solve a massive financial mystery, why the system is quite literally designed to melt your money, and more importantly, how you can position yourself to win anyway. Let's get right into it.
To really wrap our heads around why the economy feels just so incredibly disconnected from reality right now, we kind of have to look at this dual world we're living in. By pretty much every traditional metric, things should be totally crashing. We're talking a full-blown war in the Middle East, aggressive trade tariffs making a comeback, and just general economic chaos. Yet, in reality, the stock market just keeps breaking brand new record highs. It's wild. Wall Street analysts are completely baffled by it. But, as the source material points out, the stock market can stay irrational a lot longer than you or I can stay solvent. What that means is, the market doesn't actually have to make sense to you, but you definitely have to know how to make sense of the market. So let's break down the chaos that's actually driving this crazy disconnect.
The first massive piece of this puzzle is our cooling job market. The most recent jobs report showed that the United States added only 57,000 jobs. Now, to put that into perspective, economists were expecting 115,000. Actually, scratch that, it's not just a miss. We got less than half of what was expected. So yeah, the job market is definitely showing signs of serious pain, and it is slowing down significantly.
And, at the exact same time, we're seeing costs absolutely skyrocket. The conflict in the Middle East has caused oil prices to jump up by around 20% in just the last few weeks. Because of that, gas prices are pushing right back above $4 a gallon. So why is a 20% spike so absolutely crucial? Well, because oil impacts literally everything. Gas prices go up, diesel prices go up, shipping costs go up, the farmer has to pay more for fertilizer, the grocery store pays more to transport the goods, and boom, that means your weekly grocery bill gets instantly more expensive. But wait, if that wasn't enough pressure on our wallets, we've got a brand new 50% tariff on Canadian goods. And remember, Canada is the largest trading partner with the United States. This tariff covers the whole shebang, from wine and cheese to cars, cement, and yes, even hockey sticks. Because honestly, nothing says economic warfare quite like taxing a slap shot, right? A tariff basically acts as a massive new tax or fee. So if a business suddenly has to pay 50% more to import these products, they really only have two choices. They can either shrink their profit margins, or, and this is what usually happens, they pass that massive new cost directly down to you, the American consumer. All these external pressures are just driving the baseline costs of everyday life higher and higher.
Okay, let's dive into this, because this brings us to the real core mystery of our explainer today. During a time when jobs are hurting and costs are soaring, all eyes naturally turn to the Federal Reserve. The Fed's whole job is to manage inflation and the job market. Now, logically, if inflation means your savings have less buying power and your salary buys way fewer groceries, wouldn't 0% be the absolute ideal target? Like, wouldn't we all want true price stability?
Well, surprisingly, the answer is no. The Federal Reserve does not want 0% inflation. They want 2%. And our sources reveal this fascinating, kind of hidden logic as to exactly why this 2% target exists. It's not some accidental byproduct, guys. It is a very deliberate level of slow, compounding inflation. The Fed targets 2% because it's a rate that isn't severe enough for the average person to really notice day to day. When inflation hits 9%, like we saw recently, people absolutely panic. They feel it at the grocery store checkout immediately. But at 2%, the melting of your wealth happens completely in the shadows. Day to day, you don't even notice it, but year after year, decade after decade, it is compounding and systematically eroding your purchasing power.
And this brilliantly illustrates exactly what that 2% trap is designed to do. It acts as a massive, systematic wealth transfer. On one hand, you have the worker. Because of that slow, compounding inflation, the average person is actually becoming poor year after year. Their cash savings just melt away, and their hard-earned salary buys less stuff. But on the flip side, you have the investor. Inflation acts as a massive tailwind for asset prices. It artificially boosts the value of stocks, real estate, and businesses. So the Federal Reserve's inflation policies ultimately benefit the asset owners, making them richer, while the average person on the street doesn't even realize the wealth is being quietly drained right out of their pockets.
But here's where the Federal Reserve is running headfirst into a massive wall right now. They've got an impossible dilemma. Remember, their mandate is to fight inflation and boost the job market. They fight inflation by raising interest rates, which tightens the money supply. Simple enough. But they boost the job market by cutting interest rates, which loosens the money supply. You see the problem here? They're trapped. They literally cannot tighten and loosen money at the exact same time. They have to pick one.
And the crazy part is, they're being forced to make this choice while inflation is sitting stubbornly at 3.5%. That is significantly higher than their invisible 2% goal. And keep in mind, this 3.5% figure, that was recorded before the recent 20% oil spike we talked about, and before those new 50% Canadian tariffs. So the pressure for inflation to go even higher is immense, which makes that 2% mirage incredibly hard for the Fed to maintain right now. To make matters even more chaotic, the rules of the game have completely changed on us. Under the new chairman, Kevin Warsh, the Federal Reserve has basically announced they're going to stop giving predictions. No more forward guidance about what they might do in the future. Previously, the markets heavily relied on these little hints to stay stable. Now, the world's largest economy is basically flying blind. Regardless of where you might stand on the policy shift itself, the reality is we're entering a wild new era where everyone from Wall Street to Main Street is just guessing blind about the next move in interest rates.
Which brings us to an incredibly powerful analogy from the source material that really just stops you and makes you think. It goes like this. The most dangerous thing about a slow-moving fire is that by the time you feel the heat, there is nothing left to save. Man, that perfectly encapsulates this 2% trap. It is a slow-moving fire burning right through your cash. If you just leave your money sitting idle in a bank account, waiting for the economy to make sense again, you are literally letting that invisible fire consume your purchasing power until there's absolutely nothing left.
So the crucial point is, how do you actually survive this? How do you protect yourself when the Fed is flying blind and your daily costs are rising? Well, the sources point to a framework called the Always Be Buying Strategy, or ABB. The very first rule, stop trying to time the market. Nobody, and I mean nobody, knows when the top or bottom is. Instead, you buy when markets are up, you buy when they're down, and you buy when they're completely sideways. While most people are out there panicking about tariffs or the latest recession headlines, the savvy investor's job is to stay calm and just buy through the noise. It's all about stopping the habit of hoarding cash that's guaranteed to melt and focusing relentlessly on owning assets.
Because this is the ultimate hard truth of our modern economic system. You cannot become wealthy simply by working a job. And hey, it's completely understandable to feel frustrated by this, because it feels incredibly unfair to hardworking people. It really doesn't matter if you're a teacher, a truck driver, a doctor, or a high-level corporate executive. If your income relies solely on your salary, you're fighting a losing battle against a system fundamentally designed to melt your currency by at least 2% every single year. The moment you stop working, the money stops coming in. But the bills and that compounding inflation, they just keep going.
Which leaves us with one final, absolutely vital question to ponder. The 2% trap is very real, and it's quietly running in the background of your bank account right this second. The only way out is to step off the treadmill, understand the rules of the game we're playing, and start owning the assets that rise with the tide. So, are you going to remain a victim of the currency, or will you become an owner of the economy? The choice is entirely yours.